So before we end today, let's go back through the different forms of income evaluation. Gross rent multiplier, or GRM, is the price over the gross rental income, and it's primarily used by multifamily brokers and owners. We don't use it in most office or retail properties because of the lease structures being far more complex, the expenses are far more complex, and it can be very inaccurate as a measure of value. Cap rate is the NOI over the price and is the most quoted rate of return. The benefits of using this form of evaluation is that it takes into account both income and expenses, and it provides an easy way to compare building to building as if the buyer were purchasing them without a mortgage or without leverage. It's an apples-to-apples comparison of building returns after operating expenses. The only major shortcoming of this type of evaluation is it doesn't factor in the financing of the building, so it's not a real return that the investor is receiving when they purchase a building. Cash-on-cash return equals the yield, or the net cash flow after debt service, over the down payment plus closing costs, or the initial investment. Again, the yield equals the NOI minus the debt service. This is your real return before taxes and before depreciation. It's a great indicator of return when you're trying to figure out how much you would make on this investment versus putting something into the stock market or into bonds. A cash-on-cash return evaluation also allows you to test different amounts financed in order to figure out your best return with leverage. Your internal rate of return is your most complex method of evaluation. Every year you have a cash flow, and those cash flows need to be discounted back to today's dollars based on something called a discount rate. In order to compare one investment to another, we set the net present value to 0 and run a calculation using Excel or Argus or REAWise or some other software program. Remember that your first year has to include the outlay of cash to buy the building, and the last year has to include your net proceeds after you pay off the mortgage. To make this work, you have to accurately predict the property's value at that point. You have to accurately predict the amount you still owe on the building and the cost of sale of the building. You also have to predict inflation of the income and expenses, and you have to predict capital expenditures. So if we expect that we have to renovate 3 commercial units in year 5 because tenants are leaving, we estimate the cost of those renovations. If we need to replace the roof in year 6, we need to estimate the cost and deduct it from our analysis. When I'm at events, some agents tell me that they have never done an IRR calculation and they never will. That may be right, and that's perfectly fine. But my students in New York and Boston and Washington that work for big firms are required to do IRR calculations for their clients on a daily basis. It's used by institutional investors and developers. The downside of the estimate of the return is that you're assuming that the investor puts all their money back into the property or project, which is seldom true. But it does allow a comparison between various investment vehicles. The debt service ratio is a final analysis. Although this is more of a bank or a lender term, it allows us to know how much a lender will finance on a building. And it's critical because the lender will not go above a certain ratio. As a realtor or an investor, you need to understand where that number comes from in order to calculate what amount you need to invest in the property and make the DCR work. DCR again equals the net operating income divided by the debt service. I hope you enjoyed today's workshop, and I'm sorry if I made your head hurt. And as always, I truly appreciate your putting your trust into our educational programs. I don't just train, I am in the business. I consult, advise, sell, and teach, which hopefully keeps me at the top of my game. In our more advanced program on financial analysis and in our program on analyzing leases, we'll be discussing tenant reimbursements, how to handle CAM fees, base stops, how to do a sensitivity analysis on these numbers for your clients, and how to do some advanced methods of determining how to reposition a property. What we went through today seems pretty complex, but if you break it down and do some examples, you can learn the math. I want to leave you with a few quick quotes. Wayne Gretzky said, "You miss 100% of the shots you don't take. Don't let the numbers send you into paralysis of analysis." There are many very successful commercial realtors who don't actually know half of what we talked about today. Go take a shot. Christopher Reeves said, either you decide to stay in the shallow end of the pool or you go out in the ocean. So get out of your comfort zone. Stop hanging in the kiddie side of the pool. Get out there and try and list and sell commercial real estate. It's a big market with some big numbers. And finally, George Eliot said, it's never too late to be who you might have been. It's time to step up and be the person you've always wanted to be. Until next time, I'm Loren Keim, and you've been watching an introduction to commercial real estate valuation and financial analysis with the team at Real Estate's Next Level.